Hey everyone, welcome back to the Commercial Real Estate Library podcast. This is the show where we connect you with the brightest minds in the commercial real estate industry, from founders of the largest REITs to CEOs of the biggest development companies in the world. And today is no different. Today we're sitting down with Don McDonald. He is the president of Waverley Financial. He's known as the Equity King. He's known widely as the number one source for raising equity across Canada. And why should you care about this? Well, because in order to take your company from a mid or small-sized company into a household name, you're going to need to raise outside capital at some point. And Don is the man to do that. He shares exactly how that's done and what he's seeing in the market given these crazy economic times and uncertainty. Before we dive in, I want to say a quick thank you to our sponsor, Green Fox Capital. It's getting harder to do deals. Green Fox is the best source for commercial real estate financing in Canada. If you have a deal and you want to get more attractive financing, go to greenfoxcapital.com. Get in front of the best finance minds in the country. Oh, and for you brokers, they pay massive referral fees. So I know some of you guys will get a nice bottle of wine when you refer a deal. These guys will send you a vineyard. They're the best, and we love them. So greenfoxcapital.com. Our second sponsor is Portsmouth Residential. Portsmouth Residential has launched Canada's first membership-based property management platform, and they are on a mission to modernize the rental experience for renters and homeowners in Canada. What makes Portsmouth Residential different? Well, they'll get you more money with flat-rate membership fees. They'll save you more time with a 24/7 look into your investment through your owner's portal, and they'll give you more peace of mind with their exclusive rental income and eviction protection program. This is property management the way it should be. Make more money, get more time back, and enjoy peace of mind. New homeowners can sign up their properties with Portsmouth in as little as 30 minutes. Visit portsmouth.ca and become a member today and find your happy place. Thank you so much for listening, guys. Enjoy the episode.
Ready to go.
Hey everyone, welcome back to the Commercial Real Estate Library podcast. I am Dama Tamanawala. You know my co-host Garrett McGilvery, and joining us today is the president of Waverley Financial, Don McDonald. Don, thanks for being here.
Thanks for having me.
Thanks, Don.
So I think a great place to start. We have a lot to dive into. You are the king of equity. I've heard a lot of good things.
I would like that in writing.
Well, we can have it published.
That could be arranged. Yeah. But I think first what would be helpful is to just give a little background for the listeners who might not be as familiar with Waverley. All the big players in our industry would be, but for those who are not, can you share a little background on what you do, where you came from?
Well, 20 seconds on me. I've been in the corporate finance business for 35 years. I've worked for Canadian, U.S. banks, venture capital funds, private equity funds, mezz debt funds. I've been an operator. I've done turnarounds. So I've seen many hundreds of transactions over my career, which is very helpful for this business. And I've seen the balance sheet from a lot of different perspectives. So what Waverley is first of all, it's an exempt market dealer. So a lot of people don't know what that is. So essentially, we're an investment dealer, but we focus on private placements. So anything involving a prospectus will typically be done through one of the bank dealers. We're typically dealing with private companies that are selling direct to high net worth individuals, and that's done through a prospectus exemption, which is why we're called an exempt market dealer. Mm-hmm. So that's the nuts and bolts of the business. We're an agent, and we have probably 5,000 high net worth investors that have worked with us, and we work with issuers to try and put suitable investors together with their offerings. So there's really two sides to our business. One is really a compliance solution for both smaller issuers. This could be a small developer, it could be a small mortgage investment corp, it could be private equity fund, and we've done it for all of those. And it's really a compliance model where a lot of these small issuers or investment bankers, their business requires them to be registered under the securities legislation, but their size of their businesses, it just doesn't make any sense. And that's frankly pretty much the entire industry.
Right.
So what we've done, and it's now actually known as the Waverley model in Canada, is come up with an ecosystem, and it's similar in the real estate business where you've got a master brokerage and then people will white label under it. So we have the master brokerage, the technology, the expertise, the compliance systems, and then these customers come in underneath that. And rather than taking 12 to 18 months to try and register their own firm, we can have them up and running in 2 weeks, and they get the benefit from our decades in the experience. And the advantage to our clients for that is, if let's take a small MIC for instance, very competitive market. It's very hard to set yourself out from the other 450 MICs in Canada. So if people are going to invest in that MIC,
what is a MIC?
A MIC is a mortgage investment corp. So it's
all right.
Thanks. Good question.
Lender.
Okay. All right.
So it's essentially a pooled mortgage fund. People invest, they flow 100% of their earnings through. And it's a well-run MIC is an absolutely fantastic investment. But when you're starting these out, it's a yield-based investment. If people are going to invest, they're going to invest because of who you are as the founder. You're not likely to get on the shelf of a dealer and say, hey, sell my product. If you do, the commissions are probably going to kill the model. The other option is to become a dealer yourself, which again can take 12 to 18 months, is rife with liability, and then you're spending your time running a dealer and not making profitable mortgages and looking after your investors. So basically what the Waverley model is you take members of management team, register them as Waverley dealing representatives, so they can now in a compliant fashion talk to their network, put everything through our compliance system where you've had a third-party dealer that's done due diligence on the fund, you have a compliance system that signs off on the suitability of every trade, gives them credibility, but they can access their own network, which is where they're going to get their start, and their cost of capital is dramatically reduced. So that's, in a nutshell, the Waverley model. The other half of our business is, we're an investment dealer, and we have products on what we call our shelf. And what we look for is institutional grade real estate and private equity investment opportunities, and are really trying to democratize these investments to the retail public. 99% of Canadians are grossly overweighted in public stocks, and no one realizes that, and it's never had them explain to them the risks they're taking in the public markets and the advantages of being in the private markets. So we're very passionate about telling that story and how much better off people can be, and it's pretty receptive audience in markets like we're in today.
What are those benefits of being in the private market?
Well, I'll start with the short answer. The only advantage to being in the public markets is liquidity. So if you need a liquid part of your portfolio, public markets may be the way to go. It's not the only way to go, but that is absolutely the only advantage over the private markets. The private markets will provide better protection of principal, better security, better cash flow, less volatility. It really is better in every respect. And what I look for first whenever we're putting something on our shelf is risk-adjusted returns. And if you look at the risk-adjusted returns in the public markets, they're really not very compelling. Like the risk you have to take to enjoy a bull market and hopefully avoid a bear market, to me makes no sense whatsoever. So what we do, we've been at this for 10 years. Our clients make money year after year after year. They're all making good money this year. They've avoided, if you take the 20% loss they've avoided in equity market, the 15% loss they've avoided in AAA bonds, and made anywhere from 10 to 20% in the private portfolio.
Right.
They're 20 to 30% wealthier than their counterparts.
They're happy.
They're happier.
If you could just be shielded from that. I tried to buy a bigger property earlier this year, and I had a bunch of my capital tied up and not in the markets, and the markets crashed like twice while that was going on. It's and I didn't end up buying it, but that was a win. Good to be a little bit diversified.
A very lucky shield.
A lucky shield, or am I a genius? Yeah. So I just want to kind of frame what you said. So you said there's two parts of your business. The one of them is you help other people who are raising money get past the compliance hurdles. So you have a bunch of those people under your umbrella.
Yes.
And then you're also placing capital.
Correct.
So do you, which would be kind of like and not to mention maybe competitors, but would that be kind of what, if somebody says they're investing in like KingSett or Northbridge's fund, would that be similar?
We're more diversified, so we'll have everything we do has security. So it's so we're not just real estate focused, but because
Right.
we do like security, a lot of it is real estate centric. But we have everything from dental office consolidations, farmland, apartment REITs, greenfield development. So it is a little more diverse in our offering. Some is income focused, some is capital gains focused. So we try when we're sitting down with a client to see what their objectives are, what their risk tolerance is, and then hopefully have a suite of alternatives that we can direct them to meet their needs.
Okay, interesting. I just, before we move on, I just want to stick to that compliance piece. Why is it so challenging for people to get that exempt market dealers or to obey those compliance, kind of tick those boxes?
That's an excellent question. That is honestly a podcast on its own.
Okay, all right.
In short, it's a very complicated and highly regulated industry. The regulators across the country do not understand the businesses that they regulate, and I don't mind that being on a podcast and broadcast to the world because it's pretty.
See how that would be true.
It's pretty common knowledge. There's what they call proficiency requirements to start a dealer. So you'd have to take what's called for an EMD, you need to take the exempt market proficiency course. Then you need to take the partner director and senior officers course. The EMP, I jokingly refer to it as financial kindergarten. It is so basic, it is really of no use at all.
Right.
The PDO does not contain a single sentence on the exempt market. So you can take a course in origami and be just as far along in being a compliance officer.
Right.
So there's really nothing to prepare you for it. And the regulators they don't allow you to learn on the job. They demand perfection out of the gate. So it can be a fairly hostile environment, and people simply don't have the expertise. The other problem is, if you've got a fund, you want to get started, can you really afford to wait 14 months for your registration? You're at a business for 14 months. Who can afford to do that?
Right.
So the expertise is difficult to come by. The times you have to wait are very difficult to come by. The time that you're going to spend running your dealer rather than running your business makes no sense.
Yeah.
And it's expensive, and we've built some scale. We do it efficiently. We can do it for a fraction of the cost.
Okay, and just last bit on this point, what does it then cost for somebody to get under that Waverley umbrella and just piggyback off of the work that you guys have done?
It really does depend on who the issuer is and who their clients are. So from our perspective, if we're doing $110,000 deals, $10,000 trades versus $1 million trade, the pressure on our compliance system is much different. So it really depends on who your investor audience is, your stage of development, how much you're raising, that sort of thing. But
right.
It is designed to be a fraction of what it would ever cost you to be registered on your own.
Okay.
And the time to market is frankly the biggest value. I mean, if you can be up and running in a month instead of a year,
it's a game changer.
That's a lot of money.
Yeah, for sure. What have been the biggest changes over the past year in your universe?
The biggest change is going to be obvious to everyone, which is interest rates. So we pick our spots pretty carefully, and I'll give you one example of a greenfield development we're doing in Kelowna. So we have two projects. The first one's been financed, and they're micro suites, efficiency suites. So amazing amenities and green space and shared workspace and gym, etc. But 350 square foot unit that is all technology driven. But you can get into a market like Kelowna for under $300,000. So that building sold out twice over in a weekend.
Wow.
So, interest rates aren't, when there's that sort of demand-supply imbalance, interest rates aren't going to really affect that too much. Other places we look, interest rates absolutely will have an effect.
How does it work when you're raising money? Is it that, at what stage does the opportunity come to you, and then you're approaching kind of investors to get into it?
The path typically looks like we'll get approached by someone that wants to do an offering. It's always through word of mouth. Like we don't market. We don't advertise for deals. We have more deals that we can do with. So it's typically coming through a credible referral source. So we know someone we can probably trust, someone that's done business with someone in our organization before. Then we go through their business plan, like you would do on any offering, the market, the costing. We get quite involved in the structuring of the actual offering. So what the split going to be between investors and the developer, say. And
is this like, at what stage is this happening? So like as an investor, somebody goes out, they tie up, a $20 million parcel of land, and it's still conditional. Are they then coming to you and saying, here's my business plan, I need equity to close on this transaction, or at what point are they?
It's a mix. So we have done some at the land assembly stage. We've done some that, fully entitled. We're just launching one now with a very large Ontario developer. In 35 years has never syndicated equity before. They've bootstrapped everything. So it's 2 buildings. They're half built and completely sold. And he just wants to start. He's got every penny to his name in his company. So he's finally decided he's at the age he wants to share the wealth a bit. So in that case, our investors are coming into a project that's pretty much completely de-risked.
Okay. Sorry. Last question. What is equity now? Different for every investment opportunity. What does equity cost? If I go, okay, I want to get a bunch of people into this development site somewhere in Toronto, say the one that you're talking about, maybe at a high level. What does equity cost there?
At the sort of pre-entitlement stage, you're going to want to be returning, I would say, high teens, low 20s to your investors. Equity, from our perspective as a dealer, typically an 8% commission. That's pretty standard in the market.
So 8% of that.
So if you raise $10 million, it would be 8% of that,
right,
as your sort of dealer fees, and then you would want it structured with your waterfall so that ultimately, your investors are going to get high teens, low 20s.
And that'd be annually.
I love this. I'm gonna use this to negotiate with clients now. What do you mean 3%'s high? Don's getting 8.
Well, he's getting it on equity money. You're getting it on the building value.
Yeah, I know.
Yeah, we always deal with IRR, so it's compounded annual returns.
Yeah.
Right.
So I guess just in terms of bringing it back to that process, like you get approached, you have development that you're looking to potentially raise money from an outside developer. What are the steps that would be taken to set that up, and then what does it look like for an investor to be approached by you and decide to invest in a project?
Mm-hmm. So as I explained, we would typically get involved with the management team, look at their business plan, look at the market they're in, look at the supply-demand balance, look at previous developments, see how they've done, sort of the usual things you would look at the track record of the developer. So this is all before anything happens, before there's anything signed. Typically go through their budgets with a fine-tooth comb. There'd typically be several people within our firm with real estate expertise that would counsel on that and advise on that. So once we've decided this is something that our investors would benefit from, we'll put a term sheet together, deal with management saying we think these economics make sense. Like this is what we think it's going to take to clear the hurdle with the investors. And we always put that in the context of what investors' options are. So we'll compare it to other investment opportunities we've got on our shelf.
Right.
Mm-hmm.
So if you've got a mortgage investment corp or a MIC that's paying 10.5%, has been around forever, never lost a penny, don't go out with a greenfield real estate development returning 12. You need the risk premium. So that's the start. We would then do a term sheet.
And what does that structure typically look like?
It's typical. There would be a preferred return. So it's typically, let's call it a 3-year time frame. So investors would get what's called a 9% preferred return. There's no cash flow, obviously. So this is basically just they're getting ahead of the bus at that 9% a year before the developer participates. So on exit, and then let's say there's a 50-50 waterfall. So they split 50-50 the profits. So on exit, our limited partners get 100% of their capital back. Then the GP would get their capital back. Then our investors would get 9% a year for 3 years. Then we'd split everything else 50-50.
I guess just for people that aren't aware, what is a limited partnership?
A limited partnership is a very simple vehicle that is most often used in real estate, very common in real estate, and it's really a vehicle designed for investors to come in to a vehicle where they have limited liability, which is why it's called a limited partnership. So beyond the capital they've invested, nothing can ever accrue to them on the liability side, and then there's a general partner on top of the limited partner, which bears the risk of the development and the liability.
Gotcha.
Can you share, Don? So now a lot of the people that you'd be raising funds for, a lot of the deals that you're participating in, they're brand names. We probably know about them. But let's talk about some of the small, like I'd love to know the story of a company that maybe started out small that kind of grew through this structure. Like what we're curious about is, how do we, again, take, Garrett, who owns a few different buildings, right?
Can we use a different example than Garrett?
How do we take Dama,
Yeah,
who owns a condo,
Dama.
right?
Yeah,
Right?
there you go.
Like how do we just elevate it, and what does that look like
Sure.
in order to gain trust and get through the process?
So again, that's I think you're probably really talking about the Waverley model more than us acting as an agent to go out and raise capital. And what the Waverley model would allow Garrett to do, and I'm going to give you an example. It's one of our MICs called Resco MIC. So they approached us. The management had some chops in the industry. They had no money in their fund. I explained why you're not going to be able to go to a third-party dealer and raise money, and sort of convince them into the Waverley model. So they raised their first dollar through the Waverley model. They've done that 90 million more times. They've launched 2 other funds. They've grown their team. So that's actually one of the things I love about this business is, we're typically dealing with small business, and they're not only creating tremendous value for their investors, they're providing an alternative solution as the banks continue to tighten their belt. They're growing jobs, creating employment. They're increasing the tax base. So, I'm very passionate about working with smaller companies.
Right.
So in Garrett's case, Garrett. So it would be very similar.
Whoever.
Yeah, it would be very very similar. So if you're doing, putting 2 or 3 houses together, and if you're syndicating title to the house, then you don't need a dealer, because you're not dealing in securities. Once you set up a limited partnership and say, buy limited partnership units, we're going to go buy these 5 buildings, then you need me. So, and in that case, we'd probably set you up exactly like I've explained. No one's going to explain your business model better than you are. No one's in a better position to talk to your investors than you are. So we'll set you up with the training you need and the systems you need to do that in a compliance fashion. Next project's a bit bigger. Maybe in your third project, you've got enough track record that you can say, well, here's our plan. We're going to do an open-ended fund, or we're going to raise this money for a blind pool, or we've identified these assets. And then maybe you can go to a dealer like Waverley and say, hey, can you help with your investor base?
How long does it take to raise money? So you're talking about going out with a blind pool, right? If you have established a track record and everything. If you haven't yet, and a lot of it is based a little bit on your credibility, but maybe the merits of the deal. How long a runway do you need for a development site, or maybe a multifamily? You have a 200-unit building that you want to buy. Looks like you've got it tied up at a great price. You want to go out and raise some money to take that down. What does that look like?
So if it's
hypothetically,
Yeah, hypothetically.
Highly hypothetical. Again, there's 2 answers to that question. So if you're doing it through the Waverley model, and you're really going to be talking to your own network and your friends and family and their referrals, that time frame is up to you, because these are people that you already have contacts with, and they know you and they understand what you're trying to do. If you're going as a third party to a dealer like Waverley and say, this is what we're doing, can you raise me money? Then I would say minimum of 6 months.
Oh, wow. Okay.
Yeah, minimum. It takes time.
Okay.
Yeah.
Um,
So I guess just
I've never put 6 months on an APS before.
he's been deflated. His plan to buy that 200.
No, that's okay. I
building.
could go friends and family. It's all good.
There you go. Just for clarity, like what are the types of people that can invest in this type of stuff? Like
question.
you say friends and family, I presume is that everybody, or are there limitations set forth by?
No, that's an excellent question. So we're called an exempt market dealer because when we do private placements, so the regulators have said, if you publish a 400-page prospectus that no one will ever read, then anybody can invest any amount they want anytime.
Mm-hmm.
Without a prospectus, you need to qualify as a certain type of investor. And it's typically based on either your relationship with management or how sophisticated you are. So friends and family you've identified, that's a very common one, especially in the earlier rounds. You're dealing with, again, people that are close to you. The most common prospectus exemption is the accredited investor exemption. And the regulators have defined someone as financially sophisticated if they have more than $1 million in investable assets. You could be have a grade 9 education and work on a car wash, and you got an inheritance from grandma, but the way our regulatory system works, you're sophisticated. So that's the most common, is you're selling to people with some dough. It's also one of the limitations of this industry. And when I talked about democratizing these investments, I mean, everyone should have these types of investments in their portfolio. Especially people that are still up and coming in their careers, and they don't have a lot of options. So they're sitting in mutual funds, and they're, watching with trepidation their portfolio every night. Mm-hmm. And we're highly restricted in what we can do.
Has that accredited investor has that level of $1 million, has that changed over the years with inflation, or it's just
no? So it's $1 million. It's $1 million in what we call net financial assets, so net of any liabilities.
Right. Either
alone, you make $200,000 a year, or with your spouse you make over $300,000 a year. Those are the two main. Or you have $5 million in total assets. Yeah.
Interesting. We'll get back to the equity side in a moment, but you mentioned an opportunity, 350 square foot units. Garrett and I, we just filmed a podcast. We were talking about Adam Newman's new company. We're always talking about co-living and how that might become a thing. Is that something that you're excited about? Like, is that an opportunity in Kelowna? You see that kind of scaling across multiple markets?
I think it makes a lot of sense as, real estate values. My kids live in Vancouver and Toronto, and they at no point will ever be able to afford a house. They simply won't. I mean, I'm old enough. I managed to get in. It was relatively inexpensive, and you build that equity over time. I mean, there's no opportunity for younger people now to build that equity over time. So if you can get these opportunities where you can get in for under $300,000, and most people or young couples can swing that, I think that's a huge advantage for them to build some equity over time. And you also, when you guys are in the real estate business, I think the government of Canada is calling for 400,000 immigrants a year, and we need to build 10 million new homes in the next 10 years, or 3 million new homes in the next 10 years. That's a big number, and interest rates aside, I mean, that demand is going to be there and there's no supply. So that's going to keep upward pressure on prices, which means you need to find things with a lower price point so everyone can play.
What is capital chasing the most of these days? Is it, like, in terms of asset classes, is it land in a certain geography? Is it student housing? Is it, like, I know there's money for everything depending on the returns, but is there something where you've heard even in the last few months, like, oh my God, this is on fire?
Well, I can only speak from my experience and where we've focused our time. We just did a financing for an industrial land acquisition in South Surrey, BC. And I won't go into all the details, but an acre of industrial land in South Surrey is $5 million. That's, you need to be cranking out a pretty valuable widget.
Yeah.
To afford a plant on a $5 million piece of grass. So we did an amazing deal there. Our investors will have extraordinary returns. We deal with, again, it's the risk-adjusted returns. So we do a lot with apartment REITs. I think it's a very low risk real estate class, consistent, produces cash, produces capital gains. So it's a market we love. We've got a couple of very solid companies in our portfolio. The development stuff we really do on an opportunistic basis. Like, it really needs to be setting itself out from the chaff. And again, look at high demand. We always look at where the the offering is and what
Right.
what the demand looks like. But most of what we do, as I explained, is residential.
Right.
Gotcha. I guess bringing it again, I always keep bringing it back to the investment process. But say you have successfully raised the capital for an investment. From an investor perspective, what happens after that? They've put their money in, it's closed. Let's say you've raised the amount of money that they need. What happens until they get paid back?
You're talking about a development?
Yeah, let's say a development.
Yeah. So typically, or almost always, you get the issuer would welcome to them. They'd send them a certificate representing their investment in the company. And then, you keep them apprised. It's a development. Most of our guys will have cameras on site, so investors can watch the progress. We'll do, they'll do management
Live feeds.
updates. Yeah, absolutely, live feeds. And just, to be successful in this business, I'm a big believer in transparency and frequency of communication. So we encourage our issuers to, keep your investors apprised. If you hit a snag and it's going to put you behind, that happens. That's called a risk for a reason. Let people know. Mm-hmm. So we're big fans of that. But essentially, you wait. Most of like this development I was just talking about. From the time we closed the equity to the time the building was, we had the DP and the building was sold, was a pretty short period of time. Mm-hmm. So that was pretty exciting for everyone. And now we're sort of financing the next phase of that. But it's a development. There's no monthly cash flow, so you just hope it gets built in a timely manner and developer knows what they're doing.
Gotcha.
How often are people just leaving their money into now development? You can't really do that, but are they just rolling their money into your kind of new opportunities? Like, is that common?
It is common. So some of these investments will pay out, and then everything is a point in time. So, you did that investment 3 years ago. What's changed? Maybe now they retired, they need some monthly income, or maybe their kids are in school. So we always make our recommendations in the current context.
Was it a related question that you had?
No.
Okay.
No, not at all.
Again, this one's actually not on the list, but I was just thinking about how does the Canadian market for raising capital compare to, say, the U.S.?
Good question.
Easier, harder?
I don't have a lot of experience raising the money in the U.S.
Mm-hmm.
I would think their regulatory system. They have a national regulator, the SEC. So I don't know if this bears down to the issuer actually getting their check, but being in my business, all of our regulation is at the provincial level. So we're regulated. Our principal regulator is the OSC. That having been said, there's 13 provincial and territorial securities regulators, and we have to answer to them all. And they don't agree what the rules are. So I'm hoping in the U.S. with some sort of consolidated regulations, it's a bit easier from that perspective.
Yeah, that makes sense.
And I also think in general, U.S. investors have a higher risk appetite, and they tend to, this is more on the VC side, but they will tend to overfund companies and will tend to under spoon feed them. And so I think it's probably a higher risk appetite in the States.
Gotcha. Do you see anything changing, say, in the next 5 to 10 years in Canada? Whether that be, again, a consolidation of regulators or opening up the books so either more people can invest or anything in that?
That is coming slowly. So in Alberta, they have a self-attestation for being an accredited investor. Mm-hmm. And so if you don't have $1 million in assets, but you're a chartered financial analyst, they'll consider that sophisticated, which actually makes perfect sense. Or you're a CPA, or you've worked in you've worked as a stock analyst for 10 years, but you're not in that business now. Mm-hmm. So there's other ways of getting around the accredited investor definition, which I think is very positive. I don't think we'll ever have consolidation of our regulations. They spun their wheels for 6 years trying to get a national regulator and got absolutely nowhere. I just don't think it's ever going to happen. I don't actually think we need it. And politically speaking, in Canada, it can't ever happen. Quebec's not going to join. Some of the Western provinces are never going to join. But we really do need consolidated regulation, so I don't have to have a different rule for a client in BC versus Nova Scotia.
Yeah, seems like quite a headache to keep track of everything.
And following on from that, I do think, I'm very passionate about this business and what we do for our investors, and I love opportunities like this to tell the stories. And I do think, our and our industry's continuous hard work is starting to pay off, because I think more people are realizing, especially when you get into a correction like we're in now, this is, you know what, Don told me this was going to happen.
Right.
And again, I'm not saying don't invest in the public markets, but people are just generally not aware what their options are and what's available to them.
Don't only invest in the public market.
Yeah.
Exactly.
Right. Yeah. So speaking of blood in the streets,
I knew we'd get there eventually.
yeah, you see opportunities nationally. Where do you think the biggest opportunities are going to come from people who are struggling based on the market volatility?
Opportunities for what?
Like, are you seeing, like, for really strategic buys? Like, where are you? I mean, we're doing. I'm hearing a lot more about receivership deals in retail and residential land all over the place. Are you seeing that kind of thing? Like, are you guys getting?
We haven't to date, and there's certainly nothing shining through. I think those opportunities are going to be that highly opportunistic, and you find an opportunity. And I don't think there's any, one class of investment or one geography that I'm going to say that this is a hot spot. I mean, because it's gonna happen everywhere. You need to pick your spots.
Right, but if you had to.
Oh, that blood.
Yeah.
Well, I think the opportunity is really. It's obvious I'm going to say this is where we're focused now, and in markets where there's very strong demand, you're going to be less focused on interest rates, less focused on inflation. I'm a big fan of self-storage. We do a ton of self-storage work, which is great inflation hedge, interest rate resistant, spits out cash forever. Like, I just love it. You make good return and, sleep at night.
How do you feel about self-storage in kind of primary versus secondary and tertiary markets? I know some people who are buying in like way out of town. Yep.
Again, pick your spots. I mean, the we've done both. So we've done 5 projects with a firm out of Vancouver, and they're very much the primary market. So 4 of those are in Vancouver, one's in Kamloops. And these are high traffic, high visibility sites in densifying communities. So the demand for them is crazy. And the supply, like Vancouver is not issuing permits for self-storage anymore. I mean, if you're going to do something with a piece of land, they either want to have a place for someone to live or create a job. Mm-hmm. And self-storage does none of that. So they're getting really hard to find your spot. So that, again, supply and demand. We also have another company we work with, which is working more in secondary markets. So, Winnipeg, Saskatoon, Vancouver Island. But they're buying existing cash flowing properties, tuning them up, improving the net operating income. There's a lower risk strategy because there's no development involved.
Right.
But they augment their income through mobile and temporary storage. So I think there's a spot for both.
Self-storage, primary, secondary markets.
Yeah, good. Okay.
It's surprising how much of a demand there is for that type of asset class.
Well, yeah, we talk about self-storage all the time. It's like any of these business models where you can count on somebody to just forget that they're paying for it. That's like that's like getting dinged for Crave, and you're like, I forgot my password.
Good Life Fitness,
ago. Right? Yeah, exactly. Good Life.
The other thing about self-storage is once you're in, you really, like you say, you don't really pay any attention to it. And guess what? Year 2, your cost just went up 10%. You probably don't even notice that.
Right.
But to the operator, I mean, that's straight to the bottom line.
Mm-hmm.
So, not regulation-wise, but like I guess just in the private equity markets, like what do you think is going to be the biggest change in the next 5 years?
I hope the biggest change is more people are aware what the opportunities are and they start allocating some of their capital to it. I really hope that's the biggest change. I see people and they talk about what they're going through, and 2009, and I had a chart here. I just got it the other day. And, you know, when you're talking to a stockbroker, they'll say, yeah, we're in a down market and it's going to be 5 years till you come back. And that's not true. It might be 5 years for the index to get back where you started. So on paper, you're back to zero, but you've lost 5 years of investment opportunity. So there's an opportunity cost. And there's also inflation. They never inflation adjust these. So if you get back to zero, but you've had 5 years of 5% inflation, you're 25%, you're still 25% down. So if you look at the major corrections in history, they're typically over 20 years to get back to where you started.
Jeez.
I know. But I just posted a blog on my website, and it's titled, "I'll bet your stockbroker never told you this." So I really hope, if you look at what I'll call the smart money, it's the pension funds, the large multifamily offices, endowment funds, ultra high net worth individuals like the Tiger 21, which are people with 100 million or more in assets, their portfolio is typically less than 25% in public markets, and typically more than 50% in real estate and private equity. These people are rich for a reason. So again, there's a liquidity trade-off there, but nobody needs 100% liquidity 100% of the time. So that can be managed.
And again, with typically 3-year time horizons? Is that...
We have everything from 30 days to 5 years.
Okay. I still... Maybe this is just I haven't fully absorbed it. I'm still trying to figure out, like, if I want to go out and raise a bunch of money, I still... You know, so I still haven't fully wrapped my head around how that would happen.
So I guess, the question would be, like, if Damon were to go out and try to raise some money, what are the things that he needs to be, say, attractive to, say, somebody like you who would want to raise money for them?
So the biggest thing would be track record. So we're not, we're not going to, spend our time with someone that's doing it for the first time. I mean, this is other people's money. We're making recommendations on, we take that very seriously. So, which is why I came up with the Waverley model. So it would help Damon do his first number of projects, establish that track record. Then you could come to a dealer and say, hey, I don't need $1 million this time, I need 10.
Gotcha.
So that's really the biggest thing, is show that you can do it. Show you've got the chops, show you've gone through that process, show you know how to deal with the municipalities, show you know how to manage a construction budget and a builder.
And successfully exited, I guess.
Successfully exit. Yeah.
With returns.
Yeah, exactly.
Presumably returns.
And so, something that maybe I should have asked at the beginning, but what is the scale of your operation at Waverley? Like, how much money are you placing on an annual basis?
I don't like to sort of publish that. I will say this year, 28 companies will raise money through Waverley. Okay. I will say we have 5,000 investors, all of whom have made money. I will say that we had a good year in 2019, doubled in 2020, doubled in 2021, and 22 is looking pretty good.
Okay. I'm just going to say billions.
Billions. It's 9 figures. How's that?
Okay. All right. Good. Okay. Very cool. Well, I think do you have any other questions?
No.
Okay. Well, we really appreciate your time, and thanks so much for joining us on the podcast.
It's been a real pleasure. Thanks, guys.
Thank you, Don.
Yeah.